Let me now bring on board Bill Maldonado, Chief Investment Officer with HSBC Global Management. He joins us from Hong Kong. Bill, good morning. Thank you for joining us. Bill, global equities have done well for so far for 2013. You think valuations of Asian equities are looking slightly stretched now, or will it continue to move irrespective of rich valuations?
I don't think valuations are stretched at all in Asia. I think there's a number of interesting things going on in the market which will continue to probably propel equities forward for the remainder of this year. The first thing is that equities had got to really quite a low valuation level. At the end of 2012, they'd got to around one standard deviation cheap from the long-term average. And to find them at cheaper levels than that, you have to look back to some really nasty moments in financial history. So the global financial crisis itself, the SARS crisis here in Hong Kong and the rest of Asia, and the Asian currency crisis of the late 90s. So equities were pretty cheap, not rock bottom, but pretty cheap. And at the same time, they were very profitable. Profitability had only come off 15%, something like that, off the top, off the highs in 2007, say. So it was a pretty unique combination of very cheap equities whilst they were still very profitable. And they've come off those lows to some extent by around 10–20%, but they're not even back at fair value yet. There's a long way to go. To get them back to fair value across Asia, they'd have to go up another 20%.
Bill, hi, morning. At the beginning of the year, you said that 2013 will be the year of investing in a low-yield world. You highlighted three risks facing global growth: Eurozone, US fiscal adjustment, and lower China growth as well. Has any of the risks reduced?
Yeah, definitely. I think especially versus last year, we're in a much better place on the global economy. The US seems to be growing pretty unambiguously. The housing market seems to have found a clearing level, and we're beginning to see housing starts, and that's feeding through to the employment market, and that's feeding through to consumer confidence and consumer spending. It's a very consumer-driven economy, as we all know. So the news is pretty unambiguously better on the US. I think in Europe, we've all gotten accustomed to the iterative nature of the solution, and the ECB, I think, has done a very, very good job of stabilizing the situation, both in the banking sector and the government sector, taking out a lot of the tail risk in Europe. So I think investors know that it's not going to be smooth sailing, but they're sort of used to that on Europe at the moment, and there's much less panic when we hit one of those bumps. And in China, there were lots of concerns about the Chinese economy and lots of talk this time last year about a hard landing. And again, I think it's unambiguously the case now that China's motoring, it's firing on all cylinders, and we're expecting a pretty strong economy this year. So for investors, definitely the risks being priced in of a global slowdown have decreased significantly, and that's what makes us quite bullish about equities this year.
Bill, but you expect the risk-on rally to last. Is that why you favor cyclical stocks?
Well, right now, I would say definitely you should be looking at cyclicals. This is not, you know, when you come to construct a portfolio, of course, we're looking on a case-by-case basis, and we find odd pockets of value and high profitability on the defensive sides. But speaking generally, the two things that we like to see, which are cheap valuations and strong profitability, we find that most often in cyclicals, in materials, in energy, in financials. And I think it's going to be that way for a while. So that's where we're placing our bets, and that's what's worked pretty well so far this year.
Bill, how would you see the US debt ceiling to pan out, and could this lead to volatility in the near term for equities?
I think it's likely to lead to volatility, but I suspect that most equity market participants will try to look through that volatility as long as confidence remains on the growth path for the global economy and the US economy. Ultimately, I think everybody knows that the answer has to be that the debt ceiling has to be raised, and that the automatic so-called sequestration, the automatic cuts in spending, probably can't be allowed to happen exactly as they're programmed to do today. But I'm sure there's going to be a lot of jockeying around. I'm sure there's going to be a lot of negotiation, and it may go down to the wire. Of course, this happened once before in, I think, 95, 96. Larry Summers was Treasury Secretary then, and that actually led to a furloughing, a temporary shutting down of many of the apparatus of government in the United States and of employees. We certainly hope it won't go that far this time. That's not the expectation. And I do believe that the market will try to look through the volatility to what's really the inevitable final outcome.
So, Bill, what do you see potential risks to equity returns in 2013?
Well, I guess the major risk is if we get consistently negative news about one of the major economies in the world. So the three key risks that we've highlighted, one or more of those could come back on the agenda. We don't expect that. The other concern for us, for equities, would be if we start seeing companies miss earnings targets, if we start seeing big, across-the-board earnings misses, which would mean that our assumptions about the profitability of companies, and probably most other people's assumptions about the profitability of companies, would be overstated. And I think then you might see a pullback. But I don't think either of those is likely in 2013. I think there's quite a bit of momentum now in the global economy, and there's quite a bit of momentum in terms of corporate earnings as well. So we're not expecting either of those to unfold this year, but those are the risks.